This is the Weekly Outlook. Thanks for joining us at xam.com. The FX market has become the US dollar's playground recently, and this upcoming week holds two central bank meetings and important data releases. Investors, of course, will be eyeing for the next moves in the FX market. I'm Cristina Marujos. Helping me unpack this a week ahead is our lead investment analyst, Rafi Boyadjian. Rafi, let's start by looking at the United States. The Nonfarm Payrolls are out on Friday. This will be the last jobs report before the November policy meeting. So I guess it's fair to say that the stakes are rather high, as a 75 basis points rate hike isn't a done deal yet, according to market pricing. Therefore, what are we likely to see in the data, and how could the market reaction be?
Well, Christina, that is indeed correct, because although markets are edging towards a 75 basis point rate hike, they're not fully convinced of that. But I think, as far as the Fed is concerned, they've got no reason to slow down just yet. And one of the reasons for that is the very hot labor market in the United States. Now, it's interesting that a couple of months ago, we were seeing some signs of a slowdown in the jobs market, but lately actually things seem to be tightening again. So if we do get another solid report, and not necessarily a stronger than expected one, just a jobs report that is in line with the forecast, which is at the moment, analysts see the US economy adding 250,000 jobs in September. So I think we can be fairly certain that the Fed will raise interest rates again by 75 basis points in November. But where things are at the moment in terms of the global economy, in terms of financial market, we are seeing the treasury yields rising to uncomfortable levels, taking borrowing costs to uncomfortable levels for businesses, for equity markets, and that we also have a very strong dollar. In fact, you could probably argue that the US dollar is too strong, and that's starting to cause some real harm for other economies around the world. So we're probably at a stage where a good jobs report might not necessarily be good for the markets. Markets want to see a point where the Fed can say, we're at a point we can slow down the pace of tightening, and that would take the steam out of the dollar rally, out of the rally in bond yields. So that's something to watch for in terms of market reaction next week.
Let's turn to the central bank front now. The RBA meets early on Tuesday. There's no doubt that it will be hiking rates. However, the debate is whether we'll get a smaller 25 basis points hike at this meeting. What are policymakers likely to signal, and how could the Aussie react?
Well, we've had some signals from Governor Philip Lowe that they are looking at slowing down their pace of rate hikes, which they've been going at a pace of 50 basis points in the last few meetings, so they could slow down to 25 basis points. But we also got the impression that they haven't really discussed it in too great detail. So that discussion is probably going to take place at the October policy meeting. And there's a good chance that they may go for another 50 basis point hike before slowing down. And one of the reasons for that is that the risks to inflation are still on the upside. That's partly due to the Australian dollar's recent slump. In fact, up until recently, the Australian dollar was one of the better performing currencies, or the currencies not falling so much against the US dollar. That's changed, though, in the last week or so. The Aussie really took a big tumble due to that turmoil around the UK budget. So the RBA maybe might say, okay, let's go another 50 basis points again, and then we'll slow down. But either way, if we do get more concrete signals of a slower pace on the horizon, that would likely weigh on the Aussie.
Let's stay in the region. The RBNZ also meets this week, on Wednesday to be exact, and speculation around a more aggressive 75 basis points hike is gaining ground. What are we likely to see at the meeting, and how could the Kiwi move?
Yeah, so a lot of similarities between the RBA and RBNZ. The main difference being that the debate at the RBNZ is between 50 and 75 rather than 50 and 25. Now, we've had Governor Orr saying that the RBNZ has already done quite a bit of tightening, but there's still a little bit way to go. I don't think 75 basis point is a strong possibility. I think 50 basis points is a good pace for them to stick to. But you never know, because like the Aussie, the Kiwi has depreciated quite a bit lately, so that might maybe convince the RBNZ to go 75. But given that their projected terminal rate is between 4 and 4.25%, I think if they stick with 50 basis points, they should be fine. But as far as the Kiwi is concerned, I don't think it's going to make a huge difference. We're probably going to get just a knee-jerk reaction, and really, it's the global risk sentiment that's been the main driver for the Kiwi. So I think that's the broader picture for the Kiwi is still pretty much dependent on the global risk mood.
Finally, Rafi, Canada will be releasing its jobs report on Friday, and we also have an OPEC meeting coming up. What other highlights should investors keep an eye on?
So the jobs report out of Canada will be quite important, I think, because the last few reports were not so good. They were below expectations. In fact, we saw job losses in in Canada in the last few months. So I think it's going to be important that we do get some improvement for the months of September. Now, this might not be a huge concern for the Bank of Canada just yet, and unlike the RBA, RBNZ, the Bank of Canada has pretty much maintained its hawkish rhetoric. We haven't seen any signs of a shift there as far as the BOC is concerned. But it might start to, if we see further weakness in the labor market, it might start to weigh on policymakers' thoughts later in the year. Now, we're also going to get the OPEC meeting, so that's another potential driver for the Canadian dollar next week. OPEC, there's a good chance they will cut output, and that would mean higher oil prices. Of course, the market reaction will also depend not just the decision itself, but whether they're going to signal further cuts. And that could be bad for markets globally, because one of the good things that we've had lately is the fact that energy prices have been coming down. So that's provided quite a bit of relief. But if we see energy prices now going back into an uptrend, that would be good for that. That would be bad for sentiment. And should we see further turmoil, currencies such as the euro and the pound could come under pressure again. Now they're rebounding at the moment, but it's a very fragile recovery. A lot of uncertainty about not just the impact of the UK budget, should they go ahead with that budget, but also, of course, energy rationing in the winter. And if things do get really bad, we can't rule out Bank of England announcing an emergency rate hike. So that's potentially something to be on alert for.
Rafi, thanks so much. This was the Weekly Outlook here at XM.com.